following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. And now, please welcome your hosts, Mark Longo, Mike Cavanaugh, and Eric Cott.
All right, and that slightly mysterious music means it's time once again for the Advisor's Option, your go-to source for all the information you need as an active advisor these days to utilize options for proper risk management. My name is Mark Longo from the OptionsInsider.com as well as the Options Insider Radio Network. And like the man said, I am joined on the panel today by two of our regulars here on the Advisor's Option, starting off with the man from the Nutmeg State, none other than the major domo of the OIC Advisor Program. He is Eric Cott from the Options Industry Council. Eric, welcome back to the program, sir.
Mark, thanks for having us. It's all Linsanity here in the East Coast. We are going to the championship.
I never knew you were a Knicks fan.
It's all Linsanity.
Nothing but Linsanity in the Nutmeg State. And I could tease Eric because I am also a born and raised nutmegger myself. So I know from whence I speak. All right, and we are also joined here on the Nutmeg/Advisor's Option panel by the man that some of our listeners may know as Monday Mike from our Option Block program, but he graces us yet again on this program as well. He is none other than good old Mike Cavanaugh from Know Your Options, Inc. Mr. Mike, welcome back to the program.
Great to be back. It's been a long hiatus. It feels like so long. I miss you guys.
Yeah, what are we doing here on the show again? It's been so long. I've forgotten the. Oh yeah, options. That's right, options. Okay, all right. And with that, we're going to dive right into our Options 101/CE segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, and it's time yet again for our Options 101 segment. This is where we sit down here on the old Advisor's Options program and walk you through the options basics, the options fundamentals that you need to know as an active advisor or asset manager when you're thinking about incorporating options into your practice or into your portfolios. And you'll remember on our previous programs, all two of them, we discussed mostly staying on the long side of the options fence. And we discussed on the previous programs mostly staying on the buy side of the equation by talking about purchasing calls and purchasing puts for your portfolio and advantages and disadvantages of both of those positions. And if you are at all curious about those or want a refresher, I recommend you surf on over to theoptionsinsider.com or surf on into iTunes and type in Advisor's Option and then download the first two episodes of this program where we'll give you a nice overview of those positions and how they work and what you can use them for. But this week we're going to dive into a very interesting position. It's one that is extremely popular. In fact, it is probably, I would have to say, one of the most popular positions utilized by advisors these days from an options perspective, and it is called the covered call. And unlike the positions we discussed in the past, which were primarily focused on buying options, this goes to the dark side of the fence. This actually leans toward the selling part of the equation. So we're going to start talking about selling options this week and the benefits, the many benefits that could have for your portfolio, as well as some of the downsides. So let's start on that, the very basics of what is a covered call. A covered call position essentially consists of two separate parts. You have a long position in an underlying. Typically for most advisors, it could be a stock or an index, but it could be any commodity or any underlying in particular that you are trading. And then in turn, you are writing a call option against that underlying position. And the fact that your underlying could expire or be called away by that call implies that you are covering the risk of that short call is covered in a sense by that underlying position, and tends to create that, or it has lent to that usage of the term covered call. And now, so you have this position where you're long the underlying, long the stock, let's say, and you're short the call position. When should you be thinking about using this type of position? And there's usually a couple of different scenarios when advisors are thinking about using covered calls. Usually it's particularly when they have an underlying position that they already have on, or they're thinking about putting on a long underlying position, and they're not too sure. In the long term, they have a bullish outlook on this underlying, on this stock. But in the near term, they're not that sure. They think the stock might stagnate, might go sideways, might sit around for a while. And so they're looking for ways to increase their returns on that position. So that's a very idealized scenario for when you would want to implement a covered call. By selling that covered call, it creates an income or even a dividend stream on a stock that doesn't pay dividends or doesn't generate income. So it's a very nice positive for that. So that's the scenario where most advisors typically come from when they're looking to implement covered calls. Mike or Eric, have anything to add to that before we jump on to some examples and some other things along those lines?
I was just going to add, Mark, that you raised the point that when advisors start to look at using options, obviously the covered call tends to be the first one that they're comfortable with because they've probably done it for themselves. They own a stock. They're in an interest rate environment like we're seeing today where you can't find interest. So how do you create dividend on a non-dividend paying entity, which could be a stock that doesn't pay a dividend or an ETF? And what they will do is look at issuing a covered call on that position. And I think you hit the nail right on the head that an advisor is looking potentially bullish at the market, or maybe even the market might be flat. And this is an opportunity for them to generate income or potentially add some downside protection while they're waiting.
You know, that is such a tantalizing thing when you first tell that to advisors and you see their eyes kind of go wide at the concept, because so many of them are always looking for quality underlyings that also generate income and pay dividends. And when you start telling them that they could actually create that themselves on the underlying of their choosing, well, it's a very much a watershed moment for a lot of advisors when they start to say, wait a minute, I have that flexibility. I can create a dividend income stream on any underlying that I choose. Well, that's a very powerful thing to unleash upon an advisor.
I think a big part of it as well, it seems that we're always so eager to learn things in like an all or nothing atmosphere. A covered call really gives the ability to not go all or nothing. If you have 1,000 shares on a stock, you don't have to sell 10 calls. You can sell 2. You can sell 5. You can ladder it across months. Options give you options is always the old saying. You have to start somewhere, but you gotta understand. There's ways to learn, and I guess the student-teacher analogy, learn who your teachers are out there. Don't bite into the people that tell you this is the best way or there's better ways. There's no better or best. It's always what's best for the client. And that's what the advisors out there that I talk to are most interested in. They don't want to be sold on something. They want to be told, here are all the things that you need to consider. Here is how you can do it that would best fit those needs, and then you move forward from there. So I have a propensity to ramble, but it doesn't have to be all or nothing. Like 100 shares, 1 call. It's flexibility that's important.
And Eric, I believe you have your favorite, perhaps the OIC's favorite analogy for the covered call. And I was going to say it myself, but I would never deprive you of using that analogy yourself. So by all means, sir, illuminate our listeners with your leasing analogy.
Thank you, Mark. The one thing I would mention is that we tend to use things that other aficionados in the options industry. So I have to give credit where credit's due to my colleague and Professor Gaki that I think the easiest way for advisors to explain this to clients is using an analogy. And we tend to say that when if you're looking at the real estate market right now and it's very difficult, if you don't know where the market is going, look at you owning a home with your wife. And if the home is sitting empty, wouldn't it be great if you could sell an option on that home to someone to come and rent it in? You receive a premium for that while you're waiting to maybe sell the house, and the person that comes in is paying you rent because they're not just ready to yet pay you the market value of what you think the house is worth. So I bring it back down to the option world, and the idea that advisors get is I say call your client and say, look, you're holding a big position, and Mike just brought this up. It's not the entire position. One contract equals 100 shares. You look at some of your stock that you hold on the books and say, what if we leased our stock out and waited in a market that we're not quite sure where it's going to go, but we can get paid to wait? And that, I think, makes advisors think, hey, now I could start to explain covered calls to my clients.
Yes, that's a great choice, and I do echo your sentiment. I love Phil's analogies. Phil Gaki, the managing director of institutions over at OIC, is a great instructor in many senses of the word. And I think with that spirit of instruction here, let's just boil this down to complete brass tacks for our listeners, and we'll walk them through a very basic example of a covered call and what exactly we are talking about here. Let's say, for the sake of our example, that we are long 1,000 shares of everyone's favorite underlying on the planet, good old XYZ. So now we have this long position of 1,000 shares of XYZ, and the XYZ, let's just assume for our example, is trading at $100. So now you're the advisor, you have this long position in XYZ, you're starting to wonder what to do with it. Your outlook on XYZ, for the long term, you think this stock is going to appreciate, but in the near term, you really don't know. You think this thing could be stagnant, it could vacillate around a little bit, and so you're not really sure what you should do with this underlying. So at this point, you have a couple of choices. If you're really not sure about the near term, you could always sell the underlying and then invest in something you think has better near-term appreciation potential. Or for our purposes here, you could then instead sell a covered call against the underlying position. And so what we're talking about here, let's give our example. Let's say you're long the XYZ 1,000 shares, it's trading at 100. You decide to sell the front month, so the closest term trading month, and let's say you sell the front month 105 strike call. So that means essentially you are selling the call option on the 105 strike. So our listeners will remember from our call episode 1, that a call option gives you the right to buy a specific underlying by a specified price at a specified date. And so if you are in turn selling that option to someone else, you are granting someone else that right. So you are in turn essentially guaranteeing to sell that stock at 105 by the expiration date of that option. So what you have then done by selling that 105 strike call, and let's say for the sake of our example, you sell that call for $1. And you decide, because you have 1,000 shares, you want to do it on the full amount of your underlying. Remember, as we discussed in episode 1, equity options have a 100 multiplier, so every contract of an option is for 100 shares of stock. So in our scenario with 1,000 shares, you would need to use 10 calls. So you decide to sell 10 calls for the $1 price at the 105 strike. So that means essentially, if you use that multiplier by 100 and then by 10, you have collected $1,000 by selling those 10 contracts. So now you have an underlying that not really sure what is going to happen, and you have collected $1,000 by guaranteeing the right to sell it up at 105 if the stock does indeed rally there. Now, of course, so let's talk about some of the outcomes of this example. Let's say the stock stays below 105. It bounces up to 103, then down to 100 again, and then by the time the option expires at the end of the month, the stock is trading right around $100 again. Well, you've essentially collected that $1,000. That call has expired worthless, and you have essentially $1,000 of premium. So you essentially collected 1 point of appreciation, 1 point of income on that underlying position, even though the underlying hasn't really performed at all, hasn't done anything. And so you did it in that first month. That month has now expired. Those options have expired. You could then replicate that scenario over and over again and sell it again in the next month and the next month. And you're starting to see how some advisors use this strategy to generate a repeated income or dividend stream on their underlying. Eric, do you have something you want to jump in with?
Yeah, Mark, I was just going to mention that as you had talked about, that contractual obligation, that when an advisor with their clients are selling covered calls, the rights and the obligations, as we talked about on our first podcast, that the advisor and the client need to know and be on the same page that there is that potential that it will hit that strike price, and that they have to be comfortable enough, the client and the advisor, that they have to deliver those shares. So I think that, again, there are no sort of risk-free opportunities investing, but the covered call, and I think Mike would agree, comes fairly close, that you have that you know exactly what's going to happen. And again, instead of sitting on stock in your client's accounts, why not be proactive and introduce this idea?
Yeah, Eric brings up several good points, as always, Mr. Cott. The thing that I like to point out, everybody, XYZ stock, you're long at 100, you've got the June 105 call, and the first day you have the call on, the stock goes to 105, the client calls the advisor and says, "Oh my God, are we called away?" And it's not how it works. It's important to know what can happen at what strikes. So the emotion that the client may show, or the advisor for that matter that doesn't know, what happens at 105. It could go to 205 in the first day, and you're not going to get called away. So the advisor should be looking at, when does an option actually physically get called away in a covered call scenario? And that answer is easy. It's when there's no time premium left in the option, or if there's no time premium and there's a dividend that's going to be paid. Generally the last 2 days of the expiration. So that's generally, 99.9% of the time, it's not going to happen until near the end of the expiration cycle. And 99.9% of the time, the people on the other side of your options contract are going to be market makers, and they have pure financial reasons in mind for exercising that option. It's not because you had a bad day or they don't like you. It's because they either don't want to pay the cost to carry, or they want to exercise and collect the dividend. And there's no time premium left, or the time premium left, the dividend payment, or the cost to carry is outweighed to exercise than holding it an extra day. Last couple days of the expiration cycle. So we could get involved more. I don't want to scare people. I can hear the screams from the advisors out there listening to the show. But an important thing about any option strategy, I always use the diving board scenario. You're on a diving board. If the water's clear, you'll jump in because you can see the bottom. You can see there's nothing in there that, there's no rocks sticking out that you would hit in the way off the diving board. If the water's murky, don't jump in. Figure out how to make the water clear. And that's just doing the research, calling guys like Eric Cott, which I will give you his personal phone number, home and cell, that you can call him night and day, to ask about options, because he's there for you. He's the advisor's outreach for the options industry council. Particularly
at night. He prefers the 2 a.m. call, because that's when he does his best work.
He is a night owl.
Yes.
I've changed my cell phone number, but I do appreciate that now. I'm actually in the do not call list as well as the witness protection, thanks to Mr. Kavanaugh. But I just want to add one quick thing to Mike's comments, which were fantastic as well, Mark. I think we might have covered this already, but that for advisors who overlook this, that if you're doing a covered call in a non-qualified or not tax-deferred account, you do have to be aware of the potential cap gain obligations on that. However, that again, there are firms out there that do allow their advisors to do this in qualified accounts or IRAs, and then that's not a concern of yours, and that's a great conversation to have with the client.
Yeah, those are all great starting points. You guys have brought up a lot of great points here, including some of the different scenarios that unfold with a covered call. So maybe we'll just finish up those then, so our listeners who are curious. You talked about if the stock stays below 105, between that 100 and 105 range. And Mike, you mentioned that panic of, is the call going to go away? Well, that's the other scenario. Obviously, the stock rallies above 105, and that's actually, that might be a panic-inducing moment for when people are first trying their hands at covered calls, but actually that's a scenario you don't mind having. That's a scenario where you're winning. You're getting your maximum payout there on that underlying, as well as getting that premium for that call. And so the underlying will be called away, but that's not a problem for you unless the stock triples overnight or something along those lines. And we'll get to that in a minute. It's one of the downsides of the covered call.
Yeah, it's a great point, Mark. But even if the stock triples overnight, if you're not all in, if you've got 1,000 shares and you've got 4 of them out there, I have never once had a client call in screaming that we didn't make them more money. It's a good scenario. 2 out of the 3 scenarios that can happen with the stock, a covered call, you're winning. You're Charlie Sheen of the advisory world.
That's the image we want to convey.
Yeah, winning,
Charlie Sheen, baby.
Market goes up, you're good. The market stays flat, you're good. The market goes down, you're good there as well, just not as good.
And we should also mention, Mark, that for the clients that tend to be a little bit more adventuresome, I guess, or that their advisors get a real grasp on utilizing covered call, that one of the things that they have conversations with and can monitor positions is that if they're getting close to that strike price, they can always close out positions and roll them. So there is a lot of flexibility when utilizing the covered call.
Yes, exactly. And Mike, you mentioned that downside scenario. That is, of course, if the underlying does drop, it doesn't conform to your expectations, and it does drop well below 100. Well, you, at the very least in that scenario, have that $1 worth of premium that you've collected. So that's your cushion to the downside. So in our example, we sold 10 calls on 1,000 shares. So we have down to 99, we're still breaking even. Below that, you're losing money, but at least you have a little bit of cushion. Now, it's a mistake to think of a covered call as a protective downside strategy. It's not, but it does offer you a little bit of cushion. And so let's talk about that. Since we're talking about downsides, let's talk about the downsides to the covered call position itself. And there are a few. It's not a panacea. It's not a win-win every time trade, but it is a fairly useful strategy. And some of the downsides to the covered call, that as we discussed earlier, it does clip your upside in the underlying. So if you're in, let's say, a biotech name that's about to get FDA approval for a new drug and it's poised to maybe triple overnight, then you probably don't want to write at the money or near at the money calls on that name. Give yourself some upside to run. But in any other scenario, unless you're expecting an extreme near-term bullish move in the underlying, you're usually pretty good by writing that covered call, collecting that income. If the stock does get called away, you can always reestablish the position with new underlying and do it again next month. And there's nothing to stop you from doing that over and over again. So it is a very adaptable and flexible scenario. Another downside of the covered call is that it is very capital intensive. You have the underlying position and the margin on the call. So those two combined usually mean you have to keep a lot of capital in your account. So it's something you should be aware of. And of course, we talk here about options. This is a very specific, very advanced terminology. A lot of people who utilize covered calls think of them as a very low risk type of trade. On the flip side, whenever you mention to them a concept like selling naked short puts, something we haven't discussed on this show yet, but we will get to in an upcoming episode. But whenever you mention those two things together to people and you ask them, do you sell covered calls? They'll typically say yes. Then you ask them if they'll sell naked short puts on an underlying, and their answer is usually a resounding no, because that's far too risky. And it's worth noting and understanding that from a synthetic perspective, from a put-call parity perspective, from all the other perspectives that matter, from an options perspective, the covered call and the naked short put are, from a risk perspective, identical. So if you are selling covered calls on a regular basis, just know that you are indeed selling naked short puts, and understand the risk and rewards involved in both of those positions. Now, that's our cursory overview of the covered call. There's a lot more that can be learned here, and by all means, if you want to learn more, then surf on over to theoptionsinsider.com. We have a lot of great content from OIC and others. You can also surf on over to optionseducation.org, where all the guys at the OIC have a great amount of educational content on this topic. You can also call Mike and the boys over at Know Your Options, or visit Know Your Options Inc., and they will walk you through how to implement covered calls in your portfolio. Anything you guys like to add before we close out this educational segment here?
I would just add one thing, Mark, is that we're focusing on the covered call again, which is something that advisors look at, as the first sort of strategy that they're comfortable enough to introduce to clients. And we talked briefly on one of the prior podcasts about the study that the OIC commissioned along with Dubik and Associates out of New York and Bellamy Research. And just to reemphasize to the audience, one of the statistics that came back from that study relative to the percentage of advisors that used options, the number one strategy they used were covered calls, and that was to generate income. And I think that really kind of blew away a lot of the specialists in the derivative industry as well as a lot of the firms, because their thought were that advisors were using options for speculation, and that's just not the case.
All right, and that is going to do it for this Options 101/CE segment. And now we're going to dive right into our interview segment.
The interview block.
And welcome to the interview portion of the show. This is where Mike, Eric, and I find someone from the advisory world, and we force them at gunpoint sometimes to answer our questions about options and advisors and all the fun stuff going on in that part of the options business. And our guest today is Sean Heron. He is the Adjunct Finance Professor over at Rutgers University. He's also a CFA, and he's also the lead portfolio manager at Glenmede Trust Company. That must be a very big business card you carry around there, Sean.
Actually, the only thing I know are options, and I'm trying to get the most out of it.
You milk it for as far as you can go there. Well, Sean, welcome to the program, first off.
Thank you.
And what we do with all of our first-time guests here on the Options Insider Radio Network is we give you an opportunity to fill our listeners in on your background, particularly your background as it pertains to derivatives. So why don't you give our listeners a little overview of your recent history and how you came to be not only the Adjunct Finance Professor over at Rutgers University, but also the lead portfolio manager at Glenmede Trust Company.
Well, thank you. I started out in the option industry on the exchange floor as a teenager, had a couple internships, became an option specialist at 22 years old. And after going through the training program at Goldman Sachs, I began to teach options to others. So currently I'm an instructor for the CFA exam as well as an adjunct at Rutgers University. And both of those jobs just came about because they knew more and more people wanted to learn about derivatives. And my background lends itself to becoming an instructor, which I was very happy to have the offer. I've been doing that for several years now. However, my real job is managing an options-based mutual fund, as well as a full range of hedging and diversification strategies, which incorporate basically options, futures, and other structured products.
Now, Sean, the reason we wanted to have you on the program today is we've discussed quite a bit in the past on this program as well as many other programs here on the network, the dearth of options education and options educational opportunities that are available out there for advisors. And you guys in the OIC joined forces a couple of years ago to attempt to correct this, and you started an interesting program over there at Rutgers, at the Rutgers School of Business Camden, and essentially you created a curriculum there for advisors who are interested in options. You covered a couple of different things: options basics, options pricing, and then the topic du jour for today's episode, covered calls. So why don't you tell our listeners a little bit about kind of how that program got started and what the goals were going into that for the OIC Rutgers joint initiative?
So it turned out that about 4 years ago, the Option Industry Council was looking to partner up with a major university to offer accredited continuing education courses specifically to options. And it's exactly what we were doing at Rutgers already. It was in its infancy, but we had already created a course. It was a 2-day course, and they wanted to get involved with that, help promote it, and become a partner. So that's how it initially started, and we realized with everybody's time constraints that it was difficult to do the live classroom format and wanted to create a few webinars. Currently we have 3 webinars available, but the partnership is expected to grow maybe to a couple more.
So you already had courses in development when the OIC came to you. Was the plan all along to target advisors, or were these options courses for undergrads that you kind of ended up repurposing for advisors?
So I was already teaching option courses for undergrads as well as MBA students at Rutgers, and we thought about making a continued education certificate program so that people could receive a certificate from Rutgers, 10, maybe 20-hour course over a course of a number of days. And it just so happened that obviously I had some connections with the option industry, and they were going around looking into possibly working with a university, and fortunately we were able to come up with an idea that worked for both sides. Eric Cott and I were introduced, and the course grew from there.
Now, that's a good point. I think we should mention to all of our listeners that these courses are not, as opposed to the traditional 2 or 3 day seminar, you have to go in person down to Rutgers and sit in the classroom. These are actually all available online. And of course, I'm assuming they're still available online right now, correct?
Yeah, the courses can be found at a very simple website, options.rutgers.edu, or you can just Google Rutgers and OIC for Option Industry Council, and it'll take you, it's like the first link.
Well, that's great, because I know a lot of our listeners to this show on the advisor side, that's one of the reasons we so strongly feature education in this show, is because the feedback we've received from across the advisor community is we really need more education when it comes to options. So I'm glad to see that those courses are not just some standalone 3-day seminar, but actually available online for them to peruse and learn on their own time. Because we all know busy advisors need things to conform to their schedule, not the other way around.
Yeah, but I think it's important to recognize what these courses have done. There's always been a lot of basic education, whether it was a book or webinar or one-day course. But whether it was my undergrad students, the MBAs, the CFAs, or other advisors, you kind of felt like you left them hanging, so to speak, after the class. There was nothing you could turn them over to. So now that the Option Industry Council was created, the 1-800-OPTIONS, which obviously has been around for a while, but it's where you can call and ask questions, the virtual trader where you can practice these trades, I feel like after I show my students that website, they can go back and learn these concepts over and over again to solidify it in their minds, what they just learned, because it's like a foreign language. You can't just hear it once for a day or two at a course. You need to be able to work with it for a little while and get more comfortable.
And as we've discussed before, the education is indeed a significant stumbling block for a lot of new advisors, particularly looking to get into options. So what has the feedback been from these coursework, and how has the turnout been so far? Have they been pretty popular? Are you getting a lot of good feedback from the advisor community on these?
So the turnout has been pretty good. We're seeing the numbers come in. The courses are offered free, and therefore, there's a number of people who come for one course to check it out, and they stay and take all 3, which is why we're thinking about launching 2 more. Currently, we're working on one which will be more of an options on ETFs, because it seems like that's what a lot of people are using options for when they first get started, individual stocks or individual ETFs. And, we're trying to create what we think is most useful for a given environment. Obviously, option education can go across a pretty big spectrum, but we don't want to get complicated, because I think at the end of the day, the simple courses, people want to learn 1, 2, maybe 3 simple strategies and start implementing. And then once they get comfortable with those 3, maybe add a 4th or a 5th one a year, 2 or 3 years from now. You don't have to learn everything in the encyclopedia of option books to start. You can actually start with one strategy and just say, I'll trade what I know. I'll keep it to covered calls and that we're having this conversation about, and limit your risk by limiting the number of strategies you get involved in, so that there are no unpleasant surprises that ultimately make you blame options and never want to do it again.
Yeah, we've all heard that. They adopted some ridiculous strategy. It didn't work out the first time. They got burned, and they blame options and never come back. But Eric, I know you were pretty involved in setting up these courses over at Rutgers as well. So what has your perspective been on the development and implementation here of this Rutgers courses for advisors?
Absolutely. And Mark, I just want to thank you for having us on. I want to say good afternoon to everybody, to Michael out in Chicago and Sean in Pennsylvania. As you know, Mark, the option education never stops. We're 24/7 after spending time in Florida, then in California teaching, and then dealing with snowdrifts in the frigid cold. I have to report that overall investors have sort of brushed aside Greece, the Dow 13K, and l'insanity that's happening in New York City, and we're still all focused on volatility, protection, and income, which tend to be the buzzwords for 2012. But the focus on the Rutgers program, I would add to what Sean had said. We feel very fortunate to have partnered with a great university. And one of the things that Sean and I discovered a number of years back were that advisors, to take time out of the office and away from production was very difficult. So we discovered the secret sauce OIC along with Rutgers, which was to furnish these programs online, allow advisors who are accredited, whether through a CFP program or have an IMCA designation such as a CPWA or a CIMA, that they could go online, get credits, and as Sean had mentioned, call into the OCC or the OIC desk in Chicago, which is 888 Options, to further ask questions, because it's very difficult in a 50-minute time frame to learn about options.
Yeah, you certainly can't hit all the intricacies of options in one 50-minute segment. You definitely need to provide some follow-up, which is why it's such an interesting combination to have both the online courses and then the follow-up opportunities available at 888 Options that the advisors can follow up. And now, Sean, you made an interesting point. You said that you really wanted to focus on the practical elements of options for advisors because, A, you don't want to overwhelm them. There's a lot of strategies that are simply not suitable for advisors. And since the vast majority of them are long equities and they're writing calls or they're buying puts or they're doing collars and combining the two, you really need to hit on a few basics and you really cover the vast majority of what they're going to do. We've discussed on this show so many times still the hesitancy that is out there on the behalf of so many advisors to get into options. Do you think part of that is because they have this misperception that options are just too complex and they need someone to really break it down for them and say, really you need these handful of strategies and you're pretty set?
Yeah, I feel that way for two reasons. One is, with my background, I would feel comfortable doing a lot of strategies, and I find myself constantly resorting to the three you mentioned. And the only advanced strategies I find myself doing are put spreads and put spread collars. They're the only two you didn't mention, which are really just a small baby step away from what you just said. So I think with those strategies, you get 95% of advisors who use options probably only need that. They don't need much more because 95% of client risks that are trying to be hedged usually can be dealt with just those simple strategies. And it doesn't always benefit you to get more complex. If you can solve a problem with a simple solution, it's probably good enough, especially if you're using listed options that are liquid, because then you get away from the friction of trying to trade complex products, meaning cost and bid-ask spreads and cost and illiquidity, things like that. You get to avoid all of it.
Hey, Sean, this is Mike Kavanaugh. Nice to meet you in the interview today. Quick question. As far as an application, like we're talking about the practicality, I'm kind of like the boots on the ground. We've got a small RIA here in Chicago. When an advisor gets a call from a client, they went to a seminar, they've learned about options, and the advisor feels the pressure that they've got to get the knowledge base where it needs to be in order for them to advise their clients on an option strategy within the portfolio. How does your course, or are there any practical solutions, perhaps through the Glenmede Mutual Fund? Is there something that an advisor can use as a tool quickly that is practical that they can help their client when the immediacy is there? Care to take a shot at that one?
Yeah, there's two approaches you can take. One would be to position yourself to outsource option management to somebody who can customize strategies specific for your clients, and they're basically a third party shop that would do option strategies for independent advisors, so that the advisor doesn't have to either have an in-house staff or learn everything for themselves. So you can definitely outsource it. There's two ways you can outsource it. You can actually get customized strategies from a third party or buy products, whether it's an open-end mutual fund, a closed-end mutual fund, or certain structured products that utilize options to create your exposure. I think they're probably the easiest thing to do. So an advisor who doesn't want to learn options can step out and say, okay, this mutual fund does what I want to do, I'll use it. Or this structured product does what I want, I'll use that. Then there's the question of, or does the advisor want to go through the process of learning everything so they can do it themselves or take it in-house? And I think that could be difficult. Again, if you limit it to covered calls, protected puts, and collars, it's possible. But there's a lot of operational headaches and operational risk, legal risk, tax implications, things you'd have to really educate yourself on outside of basic option trading. So basic option trading, it will enable you to be able to basically trade your own money. Whereas if you want to start trading for clients, you have a new hurdle. You have operational issues, you have legal issues, you have tax issues. So you got to learn all that stuff as well. And there are courses that teach it, but you just know that if you're going to start doing it for clients, you can either learn all those other things or just hire a third party who already does it, meaning use an outside mutual fund or maybe structured products so that you don't have to build everything in-house.
That's an interesting point there you have, Sean, because we discuss a lot about the educational hurdle that is stopping a lot of advisors from getting into the option space. And that certainly is an impediment, but that can be overcome with time and some courses. Advisors are certainly capable, up to the task of learning about options. But there's a lot more lurking behind the scenes. The devil is always in the details, as they say. And in the advisor case, this is certainly true. There are a lot of issues that really still seem to be preventing a lot of advisors from diving into the option space. And you illuminated a few of them just now, the operational issues. But let's get into a little more there. You and I had an interesting conversation before the show about just what is really keeping some of these advisors from diving in. And we hear all the time, I don't have time to execute these strategies across multiple accounts. They're not very scalable, things like that. So what is some of the feedback you're hearing from advisors about what is really keeping them from jumping into the deep end of the pool, so to speak?
So the 2 points you just alluded to, the time it takes, and basically if it was a more seamless process that didn't require too much of the advisor's time, basically more automation, that would probably get more people on board. If it was easier to understand the tax implications, because one thing about tax is if you get it wrong, in the end everybody will know you were wrong, and you got to explain to a client how you didn't know something. So that's very scary. It's more of a worry than anything. And then also help advisors understand how the benefits of options outweigh the operational burden or operational headaches, because it allows you to now create solutions that are more customized to the problem, whatever, hedge you're trying to create or exposure you're trying to gain. So I think that that's what the advisors need. They need to understand that although it is work, it's worth it. They need to understand that the process can be more seamless and can be more automated. And they need to then learn, the taxes of one or two or three strategies so that they're at least comfortable with the basic strategies and there's no surprises there. And then you might start to see some people dip their toe in the water. The problem with dipping your toe in the water and not fully committing to options is it's a lot of work that, you're either going to do it or you're not going to do it. So once they decide they want to do it, it's like an all-in thing, and it's hard for them to convince themselves that it's necessary. So options tend to be a need-based thing. For people who need to use options, do it, and those who can find a reason not to will give an excuse not to and not do it. So for those who don't need it, it's just easier to run their business in the normal way with like stocks and bonds. And when they think about hedging or hedging products, they like to say, well, I can buy these VIX ETNs, which is, they may not be familiar with how the VIX futures trade, but they know that if I buy an ETN, it's like buying a stock. It has a CUSIP that sits on my book, right, like every other stock I've ever bought in the past. So they feel comfortable with that. And even though an option is just as simple and easy to buy and settle, it doesn't seem as easy. So they have a tendency to go into these products that they understand less because it's delivered to them in a fashion that they feel they understand more. Basically, it's delivered to them like a stock. So I think that that's kind of the biggest thing is people are trying to come up with a solution. And the solution is show me how to do this with a tool I'm comfortable with. And options don't seem, or futures for that matter, don't seem to be the tool. But if they wrap options and a future into a structured note or an exchange-traded product, all of a sudden they feel it's something they understand because the exchange-traded notes trade like a stock and they're comfortable. So you're starting to see a lot of people utilize those vehicles. And that ultimately may be the way they find more people using options because they don't even know they're using options, or at least they don't have the operational burden of using options, but they still have optionality in the products.
Mark, I was just going to add something to Sean's comments about the hesitancy of advisors. And Mark, you, Michael, and I have talked about this countless times, that advisors feel that they're nervous about trading options for their own clients to make a mistake, that they have issues with their compliance department. They might not be able to put on certain trades at their firm. The firm might only allow them to do a level one, which is a covered call. But I think Sean brings up a good point, is that we've talked about this ad nauseum. Advisors tend to have two things that are important in their lives. And number one is their family. Number two, it's the client. They're not looking to learn a lot about options. So it's a needs-based platform for them. And if it's delivered in the right package, they will tend to do it more. As Sean had mentioned, if it's a SMA, separately managed account, a mutual fund, or an ETF, it allows the advisor to introduce the strategy, but turn over the fiduciary responsibility to another manager, whether it be someone like Mike Cavanaugh on the RIA side or Sean Heron, where they can manage the positions for them, but they're still bringing something competitive to their client, which is either hedging or adding income.
And Sean, I think you made an interesting point too about the uptick and the adoption of these structured products that are designed to ease the burden of advisors looking to get into these products. Is that a trend that you're seeing growing in popularity? And is that something that you're in particular advising to a lot of busy advisors who are coming to you looking for options information? Let's say they're very active in covered calls, or they're interested in covered calls and income generation, and they have a very broad portfolios. Maybe something that replicates or an ETN off of the BXM, for example, would be a good choice for them. Is that something that you're starting to recommend with increasing frequency now?
So I did spend a little bit of time recommending structured products for structures that people were having solve a specific need. So, for instance, if a client said, hey, I'd like to know that I have a 10% downside buffer. If the market goes down, I lose 10% less than the market. But if it goes up, I participate. So the way they create those buffered notes is with options inside of a note, but the client never knows they have options. They just know they have this note. So in that case, yes, I like them. Specific to like BXM ETN or BXM ETF that are designed to replicate the BXM, I think it's been shown that both of those have actually underperformed the BXM by a little bit more than the cost. And I think a client would be better off doing it themselves because they should be able to outperform. But again, it's an operational problem. Some will take that convenience of someone else doing it and say it's worth the extra cost. I find that unique structured products that give you more complex exposures are definitely becoming more and more popular. Most of them have just borrowed their structures from what the insurance companies and have been offering for many years. And clients like the idea of I can't lose more than 10% this year. I get 2 times the upside to a cap. And they get all those structures. They are all created with options, but it's a lot cleaner and easier when it comes in a note. And most clients are not concerned about the counterparty risk in notes, although advisors are. Advisors are aware that Lehman Brothers went bankrupt and that's scary. But a lot of the clients think that the credit is good. So I think advisors have to make sure that they pay attention to counterparty risk because their client may not. But at the end of the day, I like a lot of those products, and I think we should use them more, myself as well as my competitors.
Yeah, you mentioned the counterparty risk. Of course, we're seeing that, and you also mentioned VIX, and we're seeing that exact scenario unfold right now in the VIX land with, of course, the TVIX, the double-leveraged VIX, suddenly shutting down for new creations, and we're seeing all sorts of issues around the NAV of that fund because of that. So there's all sorts of issues that come in when you start adopting these external structured products that you have to be aware of, and I think you're right. A lot of advisors are very wary of that sort of thing. But staying on that tip for a second, you mentioned the VIX, and it is interesting to hear you discuss the advisors flocking into VIX, because we saw a very similar pattern with retail diving into this product very early on and in many ways getting in over their heads. And it sounds like the advisors are following a similar course where they're diving into a product because they do view it, like you said, as a stock, not really understanding the full volatility component to it or what implied volatility of the S&P 500, what that really means, volatility skew, all these other interesting components, and really just looking at it as an individual stock and diving into a product that neither they nor perhaps their compliance nor perhaps their analytical abilities or their analytical software abilities are up to the task. Would you agree with that?
Yeah, I think you said a couple things, but definitely it gets through compliance because, again, it has a QSIP and a ticker symbol. It sits on your book like a bond or like a stock, depending on how you trade it. And therefore, compliance will approve everything. The real question with when you decide to purchase, whether it's a stock or volatility or a VIX ETN, is valuation. And the underwriting advisor, much like the retail community, they don't know how to value these things. So they say, well, the volatility was trading at 45 and now it's trading at 15. I want to buy it. That's like saying a stock was trading at 40 and now it's at 15. I want to buy it. Well, maybe the $15 stock should be trading at zero because the company's going bankrupt. Or maybe the 15 VIX should be trading lower because realized volatility is coming in over the last 3 months at around 10 vol. And you're actually overpaying for it. So a lot of the people don't know how to price volatility, so therefore they don't know how to price the ETN, and all they're doing is buying something that has been down over the last 6 months. And that's not a good investment strategy. You can either create a valuation metrics and use it to determine when you want to get in or out, or you can bet that volatility is going to go up or down based on the fact that it just went down a lot, so I want bet it's going to go up. It just doesn't sound like a good approach, but it seems like that's what a lot of people are doing. And they're also saying, well, I don't care what vol costs because the market's up and I need to hedge this market because I've been burnt a few times. So they're willing to overpay for these VIX ETNs, and they're actually getting bid up, and there's a lot of money flowing in them because clients are comfortable buying ETFs or ETNs, but they're not comfortable buying VIX futures, the underlying instrument. So they'll overpay for the VIX future and they'll overpay for the VIX ETN even more so that they don't have to buy a future or open a futures account. And you ask them, well, how do you value it? I mean, how do you know what the VIX futures should be worth or the VIX ETN? They have no idea. They just say, well, it's down 80%. Isn't that a lot?
Why doesn't that surprise me at all?
I have to, so we have a number of advisors I work with inside of my firm, and every one of them, every time the VIX goes into the teams, they say, should we buy this? And you can't buy spot VIX. So I showed them the VIX futures, and I say, this is what you could gain exposure to, and there's obviously contango issues. It's upward sloping over time. And it's still pretty richly priced. So most people who buy it, they buy it because they don't know it's rich. They just know they want to own volatility. And, you know, you might want to own Apple right now, too. That's probably a bad example because it's not overvalued. But some people would argue they won't buy it because its stock price is high. Like, that's not why you do it.
And then I have a question. This is Mike again. My question back to the rep that's sitting at his desk, or the RIA that's sitting at his desk right now. He's getting that call from the client, and he knows he's got to get some kind of option exposure in his portfolio. You guys are both, Eric and Sean, are saying great things about, you know, where you start. And is there a list at the OIC, or Sean, is it part of the course that you do adjunctly through Rutgers that you say, you know, here's 10 different mutual funds? I mean, not a recommendation, but a best industry practice. Like I know Mark Longo's got a group called the Options Alliance that kind of holds itself out as like an industry best practices. I mean, are there a group of guys or a list that you can say, hey, outside of Glenmede, there's these other 9 that I would recommend as well? Or is that still kind of a work in progress from the industry itself?
It's a difficult thing to answer. Eric would have trouble answering it because he can't show favoritism, and probably wouldn't want to comment on that question. And I have trouble because although I know a lot of people in my business who do the same thing, I don't know them all. So I would hate to make a list of my top 10 because there's more people I don't know than I do know. So, no, I've never done that. I can tell you people I like if you want it aside, but I've never wanted to put it in print or make it recommendation because there's just so many people I don't know who may be better.
Gotcha. That's fair.
And I'm just unaware of it.
Absolutely.
Well, Sean, we want to thank you for taking some time out of your day to join us here on the Advisor's Option today. And before you go, I know you have an upcoming appearance you want to mention to our audience. So go ahead, sir, and plug away.
Okay. I'll be speaking at the Index Conference in Philadelphia. It's called Inside Indexing. It's a number of institutional investors coming to Philadelphia. It's put on by the Index Universe group. There's a lot of great speakers, and I'm just part of one of the small panels, but I'm looking forward to it in March. Again, that conversation is managing volatility, so I'll be talking about the VIX products again and options and how they're used.
And I just wanted to add to that Sean has been an integral part for the OIC in bringing the outreach, and that, as he had mentioned, advisors can find the course through the Rutgers link, or they can also go to www.optionseducation.org/advisor, that long URL, but that will enable them to register on the website as an advisor, but also click through if they need continuing education credits. We are offering them online.
Great. Thanks again, Sean. And that is going to do it for our interview segment. And now we're going to dive right into our Industry Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market. So we do it for you. It's time to get the buzz.
All right, it is time indeed to get the buzz. We know a lot of you advisors out there don't have time really to follow the happenings, what's going on in the world of options and the options industry. And there are quite a few that pertain to you and may impact your practices, which is why we like to do it for you here on the Advisor's Option. And there is a very interesting development actually coming up in the world of options that is specifically geared towards you advisors out there who are thinking about doing exactly what we're talking about on this show, about dipping your toe into the world of options and incorporating options into your portfolios in some way, shape, or form. And our friend, our cohort, our compatriot, if you will, on the panel here, good old Eric Kott, has been very busy putting together a conference for advisors just like you who are thinking about doing this. And I know, Eric, you guys have put a great deal of work into this over at the OIC. And why don't you tell our listeners about what you guys have planned for your upcoming Advisors Conference in New Orleans?
Thanks, Mark. I would mention to the listening audience that the options industry has been putting on a conference for about 30 years. And, if we sort of fast forward almost, I guess it's almost 30 plus years now that after the first listed option traded, Mark, as we were all just young lads back then, Mike, you and me, when 1973, the first listed option traded at the SIBO. And now here we are with 9 exchanges and soon to be 10 with an exchange coming to the marketplace in the summer. But the exchanges have always put on this conference, and now what they've decided for the first time is to host a summit for wealth advisors down in the Big Easy, the wonderful city of New Orleans. And that'll be taking place in May. And we're very excited, Mark, to have you down there. And again, there's more information to be found on the institutional conference, which is on the website, optionsindustry.org.
And I, too, am looking forward to that splendiferous event that I think runs concurrently with Jazz Fest as well. So I'm very excited to meet fellow advisors that are in the option space. I think Eric and Mark have me even slated to sit in a dunk tank and be ridiculed by all the advisors that are coming there. So
yes,
very much looking forward to it.
We'll throw covered calls at you, and you can duck them in the dunk
yes.
tank.
Yes, I will be ducking straddles.
But yes, it will be a great event. Good old Mike Cavanaugh will be down there. Eric will be, as well as myself. Hey, we might even be able to do a live episode of this program down there for all of you attendees. I think that would be very fun. And Eric, I know you mentioned that the industry conference, the OIC conference, has been going on for quite some time, and it is a staple that we all attend on a regular basis. I've been going for a number of years. We do a lot of content and a lot of interesting things from that conference, but it's worth noting that this is really the first time that the options industry is putting on a separate event during their industry conference specifically for advisors. I think that's worth noting for a couple of reasons. First off, it just shows how important advisors are to the options industry these days, and how important the options world views them, that they're willing to put together a separate conference just for them within their main industry show. It just shows the effort and the lengths and the seriousness with which the options business as a whole is taking the advisor community and trying to welcome them with open arms, as it were, into the world of options.
Well, Mark, you and I have talked about this countless times over the years, and the exchange leaders, whether it's Bill Brodsky at the SIBO or David Krell at ISE or Tony McCormick at Box, all of the exchanges collectively realize that the advisors are the last bastion to bring options education directly to their clients. And based on the study and all that we're seeing out in the field, clients are demanding that there are strategies that they can use. And so, as we know, Mark, advisors, it takes a little bit of time to get them to embrace a strategy or an idea, but the fact is that more and more of them are coming on board and realizing the practical aspects of options. So it just in turn was a natural progression now after 30 years of a institutional conference to start to think about reaching out to the financial advisors or wealth managers.
Yes, and so if you're interested in coming down to New Orleans during Jazz Fest, or perhaps you're going to be in and around the area at that time anyway, I know the main industry conference is May 3rd through the 5th. The advisor conference is the 4th to the 5th. Am I correct there, Eric?
It takes place on the 3rd and the 4th in New Orleans, and it is actually happening at the same time as the larger institutional conference. And we're excited to actually have individuals from a number of the broadcasting channels as well as people in the media, including yourself, Mark, and the Options Insider Radio. So it's going to be a exciting event, but most importantly, the spectacular agenda that the exchanges have put together, I think will really deliver some great content to all the attendees.
You know, I personally am looking forward to some of the crossover between the two, some of the industry people getting to talk to the advisors and hear firsthand what they're interested in, what they're looking for from an options perspective, and also some of these advisors who are coming to options or are relatively new to it to talk to and see what's going on in the world of options, all these many developments that they're probably not going to be aware of otherwise, and things that could have a very big impact on their practice that they weren't even aware of were going on. So I think there's going to be a lot of interesting crossover, and I'm looking forward to seeing that happening and seeing to the people chatting with each other across the various sessions and the breaks and all the other times when they'll be able to bump into each other. And it should make for some very, very interesting conversation. I know we here at the Options Insider are very excited to be a part of it and to help foster that dialogue going forward.
We're excited to have you down there as usual, Mark. It always is great to sit down with you and bring you all up to speed, as well as my colleagues Joe and Gary and Phil and Alan. The one thing I would mention, and hopefully this will be something that we can discuss on a later podcast, is that the interest of advisors about using options with ETFs and the growth of ETFs, I think, is something that is catching a lot of advisors' interest, and that we're going to incorporate into our program, and we already are delivering that content out to the individual investors, through our free seminars.
Yes, ETFs are definitely the way to go these days. So many advisors are starting off with options on ETFs, so the two products very much overlap in that sense. And so listeners, if you're interested in attending this conference or in learning more about it, then by all means surf on over to optionseducation.org and you can find out more about the conference there. Or you can always call 888-OPTIONS and ask about it there. They will forward your call directly to Eric anytime, day or night, so he can answer all of your questions about the conference as well. So it should be a very great turnout, should be a very great event. We're looking forward to this first of hopefully many to come advisors conferences here in the old Options Industry Conference. And that's going to do it for our Buzz segment. That's also going to do it for this episode of the Advisors Option. I, of course, want to thank our guest, Sean Heron. So yes, if you're interested in learning more about the OIC Rutgers program for advisors, and you can find that information again at optionseducation.org or at rutgers.edu. You can find out more about it there. I also want to thank Mike and Eric for joining me on the program today. Mike had to run to go sack Jay Cutler from the Bears, but if you're interested in learning more about how to implement options into your advisory practice, Mike is a great guy to give you some practical tips. You can surf on over to knowyouroptionsinc.com and find out more about it there and how to contact them there, as well as good old Eric. You can find out more about him at optionseducation.org/advisor and all the things they have going on there for advisors. Eric, is there anything else you'd like to add before we close out this third episode of the Advisors Option?
Mark, always a pleasure to be on, and we can't wait to be down in the Big Easy with you.
I'm looking forward to it. We'll have some beignets on you, sir, and some chicory coffee, and perhaps some pralines to go with it.
You can count on that.
All right. I of course, want to thank all of you out there for downloading and streaming and subscribing to this program, and we'll see you next time right here on the Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. For more information on how the OIC can help you implement options in your practice, please visit advisor.optionseducation.org. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.